Wow, the FHA just reduced their mortgage insurance, which literally slashed the cost of getting an FHA loan. This is really exciting. This hasn't happened in a long time, and it's coming at exactly the right time in the market. If you are, I'm going to make this slide, oops, not that. I'm going to make this slide a little bit bigger because I have some numbers on here. I'm going to kind of run through the numbers, but at the end of the day, what's important is that you understand that these changes have taken place and that you may qualify. And at the end of the day, you want to talk to a loan officer that that you trust, that understands these guidelines and knows exactly how they apply to your situation, which, quite frankly, means lowering your mortgage payments, being able to buy more home. A lot of great opportunities with this. So let's dive right into it. So let's kind of start with what is mortgage insurance, right? You probably have heard of it. Basically, there are two kinds of mortgage insurance, and they get mixed up all the time. They get confused between one and the other. And there's basically two types of mortgage insurance out in the United States. Just standard mortgage insurance or standard mortgages. So the first kind is PMI, and everybody's heard of PMI. People use PMI interchangeably just to broadly mean mortgage insurance, but it really stands for private mortgage insurance. And a private mortgage insurance policy is an insurance policy that you pay for. Actually, all insurance policies, all mortgage insurance policies are a policy, an insurance policy that you pay the monthly premiums on, that protects the lender in case you default on the loan in the future. Now, you might think, well, that's kind of crazy. Why am I paying for insurance to ensure that I don't miss, that I don't have problems if I start missing my payments? But really, it's what most people need to spread or to fill that spread between what your down payment is, what your down payment you can afford, and to basically purchase a home. If you have less than 20% down payment with conventional mortgage, private mortgage insurance is required. And we're not going to dive into mortgage insurance here. We're going to dive into MIP, which is mortgage insurance premium, which you will find on all FHA government insured loans. So what we're talking about today is MIP, mortgage insurance premiums, only for FHA government insured loans. Now, there are two types of insurance premiums with FHA. There's an upfront mortgage insurance premium, which basically just gets rolled into the loan amount, and that's 1.75% of the purchase price. So if you purchased a home for whatever the after your down payment, whatever the loan amount is, if you're using FHA, they're going to tack on that 1.75 onto the actual loan amount, and then your payments are calculated. And this is how it changes. You take the loan amount times the upfront mortgage insurance rate, which is 1.75, and then you add that to the loan. Now, the upfront mortgage insurance premium did not change in 2023. Only the annual mortgage insurance premium changed. So in 2023, after March 20th, 2023, so I'm recording this, it's February 28th. So it's not quite March yet. So in March 2023, this is going to take place. Now, annual mortgage insurance is a little deceptive because you pay it monthly. So how you calculate your annual mortgage insurance premium, which is the one that was reduced by FHA, is you take the annual mortgage insurance premium rate, you times it by the loan amount, and then you divide it by 12. Then that's going to give you a monthly payment. That monthly mortgage insurance premium is then added to your mortgage payment. Now, this is the same with all FHA mortgages. If you get a government insured mortgage, there's a lot of trade-offs. They have much lower credit score requirements. They have much lower costs to get the loan. They have much more flexibility with your debt to income ratios. Sometimes it just makes sense to use a government insured loan. And so you pay this little insurance policy in order to qualify for this loan. In addition to the incredible flexibilities, the underwriting flexibilities on an FHA loan, the interest rates tend to be a little bit lower than conventional, but then they end up being about the same or maybe a little bit higher after you add the mortgage insurance. And it requires a very, very low down payment, one of the lowest down payments in the market at 3.5%. So let's take a look at some examples now. Now, this might get a little bit confusing. The way that FHA treats its guidelines is it talks about loan to value. So I've kind of translated that really into how much down payment you put. It's 6 to 1/2 dozen. It's the same. I just wanted to show it to you in a couple of different ways. So what we're going to start with, and many of you may not have known this, that if you put a down payment, so the minimum down payment is 3.5% on FHA, but if you put more, and in this case, more than 5% down, like if you put 5.5% down or 6% down, the costs actually go down. So let's start at the lowest down payment possible, 3.5 to 5% down. Before March 30th, if you had a loan amount that was equal to or less than $625,500, the annual mortgage insurance premium was 0.85. If you go over 625.5 in high cost areas, now that's only allowed in certain areas, and you have to look up what the loan limit is by county, and you can do that on the HUD website. I'll put a link here in the description to the HUD website, so you can see exactly what the loan limits are. Now let's look at after March 30th. So two things have happened. First thing is the loan limits were increased. Now the loan limits were increased across the board with Fannie Mae, Freddie Mac, FHA, VA follows Fannie Mae loan limits, and so just because of the cost of living and things like that, the maximum loan amount that you can use we're calling them traditional loan, FHA, Fannie Mae conventional, Freddie Mac conventional, or VA, or USD doesn't really have loan limits, it has income limits. Anytime, the maximum you can use with any of those traditional financing, anything above the maximum loan limit is called jumbo. And it's a different set of financing, usually offered by banks and credit unions. And it's just much higher. So, all right, that was a little bit of a rabbit hole, but it explains it explains the loan amount here. So the maximum loan amount increased. So that means if you're buying a house equal to or less than $726,200, the annual mortgage insurance was reduced from 0.85% to 0.55%. That is pretty significant. It's several $100s in your payment, depending on what your loan amount is. If you're in a high cost area, and these are your coastal areas, like your California coastal, some of your East Coast coastal, some of your Florida coastal, these higher cost areas allow the higher loan amounts. Above 726.2, it's 0.75 down from 1.05. Now, FHA loans and VA loans, both government insured loans, have a special feature called a streamline refinance. And that basically means you don't need an appraisal. You don't need any income information. You just have to have made your payments on time for a minimum of 6 months. And there has to be a tangible benefit. So the lender has to prove that by refinancing you, number one, they're going to reduce your interest rate by a minimum of 0.5%. And number two, it's going to benefit you. like you're going to benefit significantly. And that hasn't changed. So the reduced mortgage insurance has been 0.55. It's always been 0.55, and that hasn't changed. All right, let's talk about if you put more than 5% down. Now, this gets cool. It's not a huge difference, but it is a difference. If you have 5% down, maybe put 5.5% down, maybe put 6% down. But if you have more than a 5% down payment, that number actually goes from previously was 0.8 down to 0.5. So it was already 0.05 percent cheaper or less expensive. This gets a little bit, the math gets a little bit challenging. I'm hoping that I don't lose you here. But if we look at this, it was 0.85 went down to 0.55, 105 went down to 75. If you put more than 5% down, it goes down another 5 basis points. And if you're putting more than 10% down, it's the same. It's the same as if you put 5% down. So in that case, if you had, so for instance, if you have 5, 6, 7, 8% down, and it's not going to give you, it's not going to benefit you to put more down. If you can afford the payments with putting the lowest down payment, that's leverage. And that's probably the smartest thing you could possibly do. Keep the rest of that money, put it in your bank. Moving is expenses. Emergencies are expensive. It's much better that you stay liquid and you keep your money than putting it into equity in your home, which depending on the market, you may not be able to access it easily, or you may not be able to access it inexpensively. So let me give you an example and show you kind of exactly what this looks like. So this is a really good example. This is a purchase using an FHA loan on a 30-year fixed rate mortgage. Now, the interest rates or the mortgage insurance premiums on 15-year fixed rate mortgages also went down. I'm going to do that in a separate video because not a lot of people use a 15-year FHA mortgage, but there are a lot of benefits to using that in this market, especially with these reduced costs. So I'm going to do a separate video on this. So this example, minimum down payment, 3.5% down payment. You have a loan amount of $500,000. So your upfront mortgage insurance premium, remember 1.75 times the loan amount is $8,750. So your loan amount now that your payments are based off of is $508,750. It just gets rolled in there. The old mortgage insurance premium, now this doesn't include, we don't know what the interest rates are. It doesn't matter what the interest rate is in the market. As we're recording this, interest rates are the highest they've been in 20, 25 years, something like that. So this doesn't matter. This is just the mortgage insurance. So the old mortgage insurance payment would have been $360 a month just for the annual mortgage insurance at 0.85. At 0.55, that goes down to $233.18. So, I mean, it's not huge, but it's over $1,000 a year that you're saving. If you end up keeping this loan for 10 years, you've saved about $10,000 to $15,000 because FHA slashed the mortgage insurance premium. So every little bit helps. The other part about this is, now, if you're running up against your debt to income ratios, like your maximum debt to income ratio to qualify for the loan, by having reduced the mortgage insurance, that's one of the ways that you can reduce that payment so that you can afford more house. There's not a lot of things you can do to reduce your expenses in order to be able to look at a little bit more expensive houses. But this is one thing that's going to instantly do this for all new home buyers in 2023 after March 20th. You're going to get a little bit more purchasing power. You're going to get a little bit more bang for your buck. You're going to get a little bit less payment on your house. So this is really a big win for flexible FHA loans. FHA, like I said, is one of the most flexible loan programs out there. One of the challenges that I see being an independent mortgage broker is your big banks and your credit unions do not do FHA loans. So there's a lot of companies that for some reason don't like these FHA, don't like these government loans. So uh, so if you're running into if you're trying to apply for a mortgage and your loan officer keeps saying, nope, sorry, your debt to income ratio is too high, look at FHA, because the FHA debt to income ratios are so much higher than conventional loans. Plus, there's so much more flexibility. They're so much more flexible and inexpensive or less expensive if you have a lower credit score. Conventional mortgages get really expensive if you have a credit score under like 700 or 680. FHA will actually go down under 600 if you want, but it has a lot more flexibility. The high balance, so you can get an FHA loan if you're in a high area or a high loan limit or a high cost area. So actually, that's not quite true. FHA FHA's loan limits are set by county. So you have to look up the county that you're living in or that you're buying in to see what the maximum loan amount is. The conventional standard or the standard traditional maximum loan limit for traditional loans, conventional or government, is 726,200. If you live in a high balance or if you live in a high cost area, you can get an FHA loan up to $1 million or over $1 million, like in California. That's crazy. The reduced mortgage insurance premium means more purchasing power. And again, we've talked about this. The higher debt to income ratios compared to conventional makes the FHA loan a really, really good and inexpensive option. You're not sacrificing cost when you're going to it from an FHA to a conventional necessarily. As a matter of fact, in most cases, a really good loan officer is going to give you all of your options. They're going to let you compare FHA and conventional. But if you find yourself in a situation where you don't qualify for conventional, then FHA is absolutely something you should look at. So if your loan officer is telling you no, ask them if they tried FHA. If they did not try FHA, then find a loan officer that specializes in FHA. This is good news for everybody. Even though the median home prices have really gone up in the country, the median home price in the United States is $467,700. That's well below the $700,000 maximum loan limit for FHA. So this is a widely available program to almost anybody in the country. Again, you have to look up to see what the maximum FHA loan limit is in your county. But chances are most people are going to qualify in terms of the loan amount. So this stuff gets pretty complex. And I say this a lot, but your options for qualifying for a mortgage are quite literally limited to the experience or the effort that the loan officer puts into it. And there's a lot of folks out there that will not educate consumers about FHA mortgages. They think there's too many moving parts, they're too hard, whatever the case is. So work with an expert, work with an experienced mortgage professional that is willing to listen to your story, understand your story, and research the underwriting guidelines and find your options, and then present you with all of your options so that you can make an informed and educated decision. If you do not have a loan officer that you already know, like, and trust, and if you're watching this video, findmywayhome.com was started by me after the last mortgage crash in 2008, quite frankly, just to help educate you, to teach you as much as I possibly know, as much as I can about qualifying for a mortgage without selling to you. we're kind of guideline geeks. We're kind of just everybody on Find My Way Home is a mortgage expert, a mortgage professional that loves helping people, that understands guidelines. And this is a network of people that you can trust. So if you go to findmywayhome.com, you can ask your question there and let us introduce you to somebody that we know, like, and trust. Or you can scroll down to the state directory, or if you turn your location on, you're going to see a list of loan officers that are in our network that are near you that can help answer these questions about FHA loans. So I hope this was helpful to you. This is a really, really powerful tool, and this is really, really exciting about news about the FHA loan. So if you have any questions at all, you can ask questions in the comment area, or you can go to Find My Way Home. The links are in the description, and you can find a mortgage professional to ask them directly how these new rules may impact you. So I hope that helps. Thank you, and make it a great day.